Shares of Home Depot are actually now edging slightly higher, up just about 0.3%, reversing those earlier losses. The slowing housing market and also weakening consumer demand weighing on the home improvement giant once again this quarter. The company reporting its 7th quarter of negative comp sales. They also cut their guidance, now expecting sales to decline by 3 to 4% this year. Here to react to that report and more, we want to bring in Adam Baumgarten. He is a managing director at Zelman and Associates. Adam, it's great to have you here. So I'm curious, let's just start with the stock reaction here, because the stock had been under pressure initially following these results. Now we're looking at slight gains just above the flat line. Is that a bit of a surprise to you, and why?
You know, not so much of a surprise, and by the way, thanks for having me. I think coming in, the expectations for a miss on the quarter and some level of a guide down. I think, you know, if you dissect their guidance, you have a 3 to 4% comp decline. On the 4% side, that is a deterioration further in the consumer, which I'm guessing investors are maybe not assuming that, so saying, okay, maybe that 3% was within expectations. Hopefully also kind of the trough, and then we see some growth from there. So you're kind of bottoming out or maybe cutting the guidance and then resetting expectations to move higher. It's the only thing I can think of, but I think broadly speaking, it was in line with expectations.
What did you make of the broader report? I mean, the comp sales stood out to me because of the pressure they've been under for so long, for 7 quarters now. That tells me that maybe it's not indicative of the latest trend of consumer weakness that we all love to talk about. It feels like it's lasted a little bit longer, but what did you think?
Yeah, I think you've been seeing a normalization in home improvement spending in general. So there was the huge surge, as you know, in 20 and 21, and we've been giving back some of those gains. Part of that is the shift in share of wallet from goods to services. And I think even within goods, you saw a surge in home improvement and then people buying other things over the last few years. So some of that pull forward is still normalizing. We think that is back to somewhat normal as a percentage of overall consumer spending by the end of this year. So that's why we think next year you do return to growth for comps at this point. But you know, any kind of recession, which is not built into our forecast, could push that out a bit more. Also, I think there was a bit more optimism earlier in the year as there was, you know, more of an outlook for rates coming down earlier in the year. And now that's been pushed out, as we all know. So that has a lagged effect on home improvement spending. So that's probably more of a 2025 phenomenon versus I think most people thinking in the back half of this year it would have been a bigger contributor.
So a big driver is this very much more so, and we heard this from the executives this morning on the call, is it very much a deferral mindset versus continued weakness that you're expected to see, just given the fact that we could see a return of some of that spending once we do get lower rates?
Yeah, I think it is a bit of a deferral. You're starting to also see home prices start to flatten out. They've been a nice positive story, even in a market where existing home sales are pressured. So I think a couple things. If you continue to see home price growth, and then you start to see that turnover pick up, which has been absent the last couple of years, down about 20% per year over the last couple of years, on the margin, that does tend to help home improvement spending as homeowners, you know, when they sell the home, they fix up the home a little bit beforehand, and then the new owner tends to spend money on it. So I think that's probably a catalyst as we move forward. And we're starting to pick up within our, you know, network of contacts that listings are picking up. So that supply is finally starting to hit the market. The question is, are people going to be confident enough to buy a home in this market where with all the talk of recession and things like that?
Well, what are you looking at in your models to suss out that question? Because we were talking about how you only cover housing as a firm, and I wonder how you have stocks that are doing positively in this environment within that, right? So what do you look at to determine that the housing market is on track for recovery?
So we look at, as I mentioned earlier, that share of PCE. Now, we don't forecast consumer spending overall, but within PCE, we use kind of the consensus forecast, and that's for growth. And historically, you've seen a home improvement market grow about 3 to 4% per year. And that's what Home Depot's talked about. And that's kind of where we expect the industry to get to next year. And part of that is some of that positive home growth you're still seeing. Consumers are still in okay shape. There has been some level of deferral. And I think what's important within the spending is you saw the discretionary piece really skyrocket when home prices went up and we were getting stimulus and things like that. But there was also a pull forward of traditionally maintenance-driven spending. So think about, you got to replace your roof, faucet breaks, appliance breaks, you typically fix it. That's, by our estimates, about 30% of demand. That was also pulled forward into 20 and 21. People had the money. They were maybe spending more time at home. They said, you know what, I know I need a new roof in a few years. I have the money now, I'll do it. So there was some pull forward of that. That's something that we think is behind us, and that continues. That's kind of a GDP type grower. And then I think you just see the reversion to kind of typical consumer spending patterns and home improvement starting next year.
All right, Adam, thank you so much for joining us. Really
Thank you.
Appreciate you coming in studio as well. Thank you so much.